Hey, well, hey everyone. Thanks for joining us today. I am Ari Markenson. I'm a partner in the healthcare and corporate groups here at Venable. I am my practice is focused on healthcare M&A and healthcare regulatory work. I am joined by Pete Tedesco, a managing director at Avesi Partners. Very happy to have Pete join us today. I'm going to have Pete introduce himself in a second as well. Just to get a little bit about what we're going to do today. Pete and I are going to have a nice conversation about what's going on in private equity, healthcare investments. And also in terms of our series of these kinds of talks with folks involved in investment and M&A and healthcare. I just want you to know that in January 24th, next month, towards the end of the month, I'm going to have a conversation with Vasanta Pundarika from Matrix Capital Markets Group, talking about her thoughts about the market as well. With that said, why don't we get to our star of the hour, Pete, who I'm going to have a really wonderful conversation with. Pete, why don't you introduce yourself?
Sure. Thanks, Ari, and thanks for having and hosting me today. In a great session. Looking forward to the conversation. So, Pete Tedesco, I am a managing director with Avesi Partners. Avesi is a middle market private equity firm focused primarily on healthcare. We do some business services investing as well, but predominantly healthcare focused. About 75% of what we do is and will be healthcare. We're typically the first institutional capital into the companies that we invest, so often partnering with founders and founder-led and run businesses. The firm's relatively new. We have our debut fund that we're investing out of. The first fund was closed in the summer of 2021 on $875 million. So we're still investing out of that fund. Have 4 portfolio companies with a few more pending. And we tend to be very thematic driven. It's one of the reasons, really interested in kind of exchanging some thoughts and ideas with Ari today. We're kind of constantly surveying the landscape and putting outbound efforts to find opportunities where the puck is headed in healthcare. Maybe a little bit away from where there tends to be, a little bit more focus and kind of frenzy in private equity investment. So. With that, I'll maybe jump into to our discussion.
So Pete, I don't think I've ever posed this question to you before, but I will, which is, we've had a lot of conversations, you and I, about what's going on in the marketplace and who's doing what and why and how, and we're certainly going to talk more about that. But it would be interesting to hear a little bit about personally, sort of, what put you into the space in which you're in right now in terms of what brought you to investing in healthcare?
Sure. Yeah. Well, I started my career actually as a M&A banker and an industrials banker at UBS in Chicago, and not for passion for either of those pursuits necessarily, as much as that was the opportunity that kind of was in front of me. But I first got exposed to healthcare and healthcare investing as an associate at Wad Capital, so all the way back in 2007. It was pretty quickly hooked. Most of what I did, and really all of what I did at Wad Capital was healthcare, and worked very closely with a number of our portfolio companies, surveying the landscape and kind of getting up to speed on the industry, really. A few reasons that I've kind of stuck with it throughout my career. The regulatory landscape in healthcare, it makes it a little bit of a specialized knowledge set. And I'm talking beyond just the acronyms and kind of understanding what people are actually talking about in healthcare. But particularly in the U.S. system, it's not easy to sort of pick up who's paying for what, and how the dollars are flowing, and referral relationships and all these different nuances of healthcare. And so as you think about areas that are maybe a little bit more unique, your general investor in other spaces couldn't very easily, just kind of flip into healthcare and say, all right, now I'm going to pick this up. So it felt a little bit more kind of insulated and specialized from that perspective. Obviously also a huge percentage of GDP, but kind of fairly insulated across industry cycles. So I thought about kind of building a career. Those two pieces were important, and then the final piece that I really got to experience working closely with some of the companies we were building at Wad Capital. Look, as an investor, you can make money doing a lot of different things. One of my former colleagues used to say you could be investing in gravel pits in Des Moines, and make money that way. But investing in healthcare, if we're doing it right and we're successful as investors, at the end of the day, we are improving access to care, lowering costs, improving quality. Things that look, I don't fancy myself a frontline clinician. I think nothing's shown that better than everything that went on during the pandemic. But at the end of the day, if you're investing in this space and you're doing it well, there should be a decent kind of patient and societal impact. So all else equal, that feels pretty good, and something I've really enjoyed pursuing.
You actually threw out there something that leads us to the next kind of thing I want to talk about more broadly, sort of go micro to macro, right? Which is, why do we, your sense of sort of why is healthcare, even with all its challenges, even with regulatory environment, right? Why is it still so attractive? And you've got, frankly, so many more middle market entrants into healthcare investing, like almost monthly, right? What kinds of more macro things can you impart on us about why people just seem to find this space so attractive?
Yeah, well, I did hit on one that's just GDP, right? It's a big piece of the economy. Certainly here in the U.S., but everywhere. Now you can't necessarily invest in it as easily in other markets. So I think that's a one very kind of easy and natural answer. But if you dig a little bit more deeply, again, tends to not be as cyclical as some other aspects of the economy. Unless there is a global pandemic when all of a sudden health and healthcare is right in the crosshairs. That said, even as I joke a little bit about that, healthcare bounced back so quickly, in most areas, coming out of the pandemic, and really, obviously did a lot to address the issues that were happening. So, kind of that stability of the industry, I think, is another piece that investors seek. And then taking a less macro, sort of coming down into, okay, what's going on in healthcare itself, and again, particularly in this country, just huge opportunities for innovation and increased investment. Whether that be, innovative models of care delivery, innovative payment models, or even just, the technological infrastructure, underpinning a lot of the healthcare in this country that's been woefully underinvested, over the years, and really we just have such opportunity. It's so far behind, the financial services industry, to pick one, but many other industries on the technological side. So I think there's a lot of different areas within healthcare that are sorely lacking in kind of historical investment. And ironically, even as we've seen more dollars flow into the space, we're still pretty far behind, kind of the times at some level. So it creates a lot of opportunity for again, kind of innovation and advancement through investment by private equity firms.
Yeah, something that I've always found interesting is that it almost seems illogical, right? That by any you could just Google, the U.S. healthcare system in comparisons to other healthcare systems, right? And the types of data that come up almost immediately, right, is the fact that we're spending up here and our outcomes are down here compared to everybody else, right? And it's almost seems illogical, although there is there's actually an insanity that does make sense. It's a funny way to say it, whereby the folks that are trying to fix that, right, that are trying to figure out how to fix the fact that we're spending an enormous amount of money and not getting what we should be getting out of that money, that there's investment opportunity there, right? that there's investment opportunity in trying to solve that equation. The company that uses technology to make something more efficient and make us, for example, get better outcomes with respect to some chronic condition with less money, right, is actually a winner in the space. And if you think about, if you're not thinking complete macro about, a third of GDP being spent on healthcare kind of thing, but you're actually thinking about finding that one diamond that is figuring out that answer to that chronic condition, right? Well, that's good investment, right? And so I think that's something that folks have to see, particularly when they think about how private equity is contributing to sort of what we're trying to solve for Exxon, right? When you think about particularly healthcare services.
Yeah, I mean, I think private equity investment in healthcare can get a bad rap sometimes because philosophically, I think we as a country and a society here haven't yet figured out how exactly we think health. Is healthcare a right? Is it a privilege? Should it be privatized? Should it be public? And is it right to ration care? Et cetera. But I think one of the aspects, it's not to suggest that everyone that's investing in the space is doing so, out of the goodness of their heart and to, solve systemic, kind of issues. But I do think without, the investment that's coming from the private markets, we're going to continue to, kind of be behind, whether that's in, outcomes or just, accessibility of data and interoperability and, all these other areas that, just need, additional investment and support to really take us into kind of, I would say, the next century, though we're almost a quarter of the way into this century. And I think one of the other kind of interesting sort of features is no matter how much we are kind of investing, a lot of these problems are going to be tough to solve. I always think of the fact that there are many billions of dollars in kind of the revenue cycle of healthcare on both the payer side and the provider side, kind of fighting over who's paying whom what, and technology and services and tech-enabled services where effectively each group is kind of trying to arm themselves to better fight against the other. That's a inefficiency when you look just from a 30,000 foot view, and yet there's a tremendous need for these kinds of tool sets from a payer and from a provider, to be able to candidly stay alive, stay in business, and run their companies better. So it's one of those, I think, often a double-edged sword when we just think about the market broadly, but just so much need for this private investment.
Yeah, I think it's one of the things that's interesting, right, is and again, it's interesting because I think it creates opportunities for investment, right, is that we have everybody refers to it, textbooks refer to it, right, as a system, but we have a lot of different actors, right, within healthcare, labor, the providers themselves, the payers, the employers. It's just so many different actors, right, and with differing interests. right? Different stakeholder interests.
Yeah.
And one of the things is that when if you look at a completely sort of one silo system whereby all of those things are in one silo, right? A national health type system. Yeah, much easier to control drug costs, much easier to know how much you're paying professionals to provide professional services, much easier to know what you're going to be putting into building hospitals or long-term care facilities or senior housing or those kinds of things, because it's all centrally controlled, for lack of a better term.
Sure.
But you can just as well look at some of those comparative systems and see that their outcomes actually aren't well beyond ours, right? Even though they may have that control. And we funny enough, that fragmentation, right, with our system, just again, leads for opportunities for good investments and for trying to answer more discrete problems than the entire problem, right?
Yeah.
Let's talk about the fact that, and I've done a bunch of this conversations with different folks over the last few months, it's just sort of how this year's deal volume, and I'll say it in the sense that, look, the market's deal volume, even outside of healthcare, is down dramatically, right? But certainly within healthcare, deal volume has been dramatically down. And what's your take on why, where, and how?
Yeah, there's not one kind of quick answer to that, but I guess it's good that we have fair amount of time together to chat through it. But yeah, look, I think there's I'll hit on a couple points. So one, obviously, kind of interest rates and off trying to offset inflation, put a big damper on the market generally over the last, call it 18 plus months. Geopolitical, sort of issues are not helping anyone just generally feel good about, the world and the economy and kind of capital allocation. I think there also is a little bit of a reset that's kind of happened and happening from what probably were unsustainable levels of deal volumes and valuations from kind of as particularly in the healthcare private equity market coming out of COVID and kind of middle and later part of 2020 through really early 2022, where quarter over quarter, or record deal volumes, record valuations, capital raises, et cetera. That probably needed to cool off kind of anyway. But then if you think, I'm in the position of a seller, a founder who started a business, and I don't necessarily have to transact today versus a year from today. I'm probably gonna hold off, if I can. And with the general concept of things will be better in the future if I don't need to do anything, but also, if I saw or thought about or had a number in my head based on a 2021 kind of valuation. Now I'm trying to wait till we can get back there. And obviously there's two pieces of that. One is, what's kind of the market, providing, and two is how's my business performed. And I think another piece is, inflation hitting a lot of areas, and one, kind of inflation slash just general difficulty in the labor market. So particularly for provider businesses, but really across just about everywhere in healthcare and everywhere in the economy. Labor was a real issue, has been since kind of the middle to the latter part of 2020. Your labor costs have gone up. If you've been able to find folks, often lack of staff has constrained growth for a number of these companies, and so maybe their performance isn't quite kind of where it was. And then, so I think there's this general sort of dislocation between, where a seller is willing to sell and where a buyer is willing to buy. That's kind of happened throughout a lot of this year. Add-on activity does seem to still be pretty high. So I think those of us on the investment side that have existing portfolio companies have really focused in on the portfolio, and shoring up those companies, creating value through add-ons and de novo growth. Look, there's still so much capital on the sidelines that that's going to need to find its way out. And when I say capital on the sidelines, I mean private equity firms that have raised a lot of capital, private debt firms that have raised a lot of capital that are looking for places to put this money. So I think things will, and we can get to kind of predictions for the future. I think things will need to even out over the last kind of from where they've been over the last 18 months. But I think for this year it's been tougher sledding for kind of all the reasons I just hit. One, I'd be curious, and kind of flip the questioning around a little, Ari, but curious your thoughts on some of the legal aspects that could be influencing how certainly investors are viewing opportunities in healthcare specifically, and kind of high level concepts like increasing, well, just in general increasing kind of regulatory scrutiny, particularly tighter restrictions and a number of proposals around non-compete agreements, antitrust getting seemingly tighter, or at least more scrutinized. Curious what you've seen from those and other kind of healthcare regulatory impacts that may be kind of cooling appetites for investment.
I think, look, it's almost like we are on a cycle to some extent, although not at a great place right now, in the sense that, as kind of healthcare can go through a period of a lot of enforcement from different areas and things that are making folks crazy, and then it can go through a period of smooth sailing, right? Right now, though, we have probably a more significant impact, if you want to say dip on that cycle, right? Of regulatory scrutiny, antitrust scrutiny, pure billing and coding, fraud and abuse type scrutiny, right? The issues around non-competes. Let's just one issue, one very important issue there, right? There's so much particularly lower middle market investment, for example, in professional practice management.
Yeah.
Well, the value there, right, almost entirely results in your ability to lock in those professionals to practice with you for a period of time, right? If what you've done is, if what you're faced with is paying an enormous amount of money to a group of professionals to join your organization, and then as a result of regulatory prohibitions, you can't lock them in, well, you're not going to pay them much, right?
Yeah.
Their business becomes almost devalued. And it's very interesting in that sense, because you don't necessarily see a contingent of professionals saying, well, wait a minute, you're devaluing our businesses by implementing these kinds of things. And I just don't think frankly, I just don't think that the professional world sees it, right? They don't see that issue, that if you are interested in a association with some sort of professional practice management firm that's private equity backed and are looking at a significant exit from your business as a result of that, or a monetary event, right? you're not going to get it, frankly, if the state that you're in and or federally, right? You know, by law, they can't impose any kind of restrictions on you in terms of non-competes. And on some other things that you mentioned, you know, look, this is not, the government's just gotten smarter about how they're looking at these issues, but it's nothing new in the sense that if you are a fund, to think of yourself, and this is my own soapbox 2 cents, right? But to think of yourself as a completely passive investor, right? Particularly where you're shooting off emails to the CEO of a portfolio company saying, you know, why aren't we selling more X today? That doesn't work, right? It doesn't, the government sees that, right? And if that interaction either has a direct result or even has the potential to have a direct result in some sort of violation of the law, right? The government isn't just going to say, well, yeah, we know you're just the investor, right? No, you had your hand in the till, right? You directed how that company was going to do or not do something there, and you could be taken to task for that. And I think, by the way, I think that at least everything I've seen, right? Everything that I've seen where an investor has really gotten on the hook, or at least there's been an attempt to get an investor on the hook for something that occurred with a portfolio company from a regulatory perspective. Now I'm talking about fraud, abuse type issues, right?
Yep.
Has it really been a either I knew about something and I completely stuck my head in the sand and ignored it, right? As a perfect example, by the way, the worst thing that an investor can do is hire great health regulatory firm, me included, right? Somebody like me to go in and kick the tires, okay? And the memo that's delivered to them about the entire diligence process, particularly the regulatory diligence process, right, just gets thrown in the garbage once the deal's closed. But yet the folks you had do your health regulatory diligence raised both you know, the law firm as well as the consultants, whoever it might be, right, raised some issues that may not have been red flags, don't do the deal, but they were, you better look at this and make sure it's not a problem. And the government can essentially later on say, hey, you stuck your head in the sand. You had a piece of paper from some pretty smart people in your hands that said, you need to take a look at this. And you just ignored it, right? And one of the things that folks don't recognize that's a serious issue in, particularly in fraud and abuse prosecutions, right, is that the standard with respect to whether or not you can get yourself hung, right, is not just I specifically knew what the statute said and I purposefully violated the statute, right? The standard often is as simple as I kind of had an inkling that I was doing something wrong and I decided not to do anything about it, right? That's a little bit different.
Sure.
And that comes into play, particularly with that kind of diligence, those kinds of diligence issues, right? You know, and the other thing that's coming up now, right, is antitrust. I'm certainly no antitrust expert, but we're starting to see, you know, the proliferation of, particularly in practice management, right? If you're trying to build a practice management structure that is, there's some other similar type structures that's essentially, you know, monopolizing, again, I'm using that word for a very specific purpose, right? Monopolizing a community in eye care or I'm making this up, right, in gastro or whatever the heck it is, right? You run the risk of having antitrust concerns. And folks generally kind of always felt that, oh, well, if I'm just doing this with these onesie twosies, you know, one dental chair practices, and I just end up buying up all the dentists in, you know, a 5-county connected county space, well, you know, that's not an antitrust issue. Well, no, it could be, right? And so that's something for folks to really have to start thinking about, that antitrust is simply not just about big acquisitions, right? It's about market power. And so, you know, look, is it a time for folks to get, particularly investors, to get more attuned to those issues and be careful? Unequivocally. Is it going to stop people investing? I don't think so. So
Yeah, but it does. It's just it's harder isn't maybe the right word, but it's it requires maybe it gets back to one of the sort of specialized knowledge set and an experience and then having folks like yourself and good advisors around you that can help you navigate what is a more difficult kind of legal regulatory compliance kind of environment than certainly at any point in kind of my career.
yeah, and I have throughout my entire career, I get it, I work with it, I understand, the red flag nomenclature, right, makes me insane personally, right? Because yes, I'll tell you, look, I don't see something here that should stop you from doing your deal, right? I wouldn't tell you not to write the check, generally a decent business, but I gave you a lot of buts, right? And they're all buts that can be resolved by a little work on your end and some money, right? Please don't take my not saying that there's a red flag being waved here as me saying, go ahead, do your deal and ignore everything else I just told you, right? But often that's what happens, right? Look, everybody loves good closing dinner, right? Like just to move on and start integrating and get your portfolio company going. But fact is that you have to really make sure that you're not kind of leaving those things on the table because they really can come back to bite you.
Yeah, absolutely.
This conversation kind of leads us into another conversation about what's really sort of happening in the marketplace now. And that's about not just about the fact that deal volume is down, but and this is, I think, been going on even though we had a lot of deals happening during the pandemic in some ways. I think we still saw this, even almost pre-pandemic, a lengthening of the time in which folks are starting to talk to somebody and getting something done, right? It's not just about the fact that there may not be enough consultants to do diligence or lawyers to do the deal or whatever, right? There's something more going on there. And so sort of, I'll put it to you first, sort of, what do you think's been some of the reasons for why deal timing just seems to be drawn out?
Yeah, well, look, obviously, granting that it's kind of a case by case, deal by deal, case by case basis, I'll generalize with a theme or two that I know are happening. So look, some of what we just walked through, right? It is more complex. These compliance regulatory topics, are things that just take some time to get your arms around, to get comfortable with, and say, okay, we feel good about moving forward with this investment. So look, just dovetail on what we just hit. That certainly can and probably is a piece of it. I also just think buyers or investors are digging in more and are holding companies to a bit of a higher standard. And whether that's purely driven by buyers having some leverage, I don't think so necessarily, just given what we've seen in kind of deal volumes of late. I think probably is more driven by for lack of a better term, kind of a flight to quality and on the flip side, just a real aversion to taking on kind of undue risk. As interest rates have bumped up, as the economy's been a little bit bumpier, I think you've seen investors and buyers really focus on minimizing the downside, and kind of knowing that my downside case, I'm still going to be okay. versus, you know what, it doesn't necessarily matter if my downside case could be catastrophic because the upside case is just so exciting. I got to put all this capital to work. And we were in this kind of, frenzy, I think, for a little period of time, kind of immediately sort of post-pandemic. So, what I think is happening is just a more granular approach towards diligence and towards processing, ultimately kind of capital allocation from investors. And that has resulted in, I think, is more aggressive valuation, interest, process, et cetera, for companies that are more stable, and just less interest, lower valuation, maybe no pathway to an investment or transaction for companies that are a little bit more dinged up and maybe have the potential for a bright future, but are a little risky. In this environment where we've been, at least over the last 18 months, the appetite for kind of taking on risk is just much lower. And so I think part of it's driven by that. Look, I'm going to uncover every stone. Whereas maybe prior to the market's turning a little bit, folks weren't necessarily as concerned with taking a full 90-day plus exclusivity period to just comb through everything.
Yeah, it's interesting because I think that we had, even way pre-pandemic, had flipped back to a sort of marketplace of I'll buy it and I'll fix it later, right?
Right.
It was a period of time, a couple of years, where it was just like everything's got hair on it. I'm just going to buy it and we'll fix it. And then it certainly, into the pandemic, when there's certainly deals stopped, but then when they started up again, you had this sort of, not going to do that. And I think that's what you really just said, right? Yeah, I'm not, this idea of, I got a lot of money, yeah, I know, but I'm not, the idea of spending a lot of money on something that I'm just got to fix, I don't really want to do that right now.
Well, and it's, if I know that I need to fix it, it's okay, seller, you fix it, and then come back to me when it's fixed.
Yeah. Okay, why don't we transition to talking a little bit about things that you think are interesting, right? Like what are subsectors does it seem like folks are interested in, or are you interested in general?
Yeah, and maybe I can kind of go in both those routes. Folks interested, and then we're interested, not to suggest that they're entirely divergent, but again, we're always trying to be a little bit outside of of kind of the current frenzy. So in PE generally, I think you've seen a lot of more recently investment in cardiology on the physician side, orthopedics still quite a bit. Med spas, suddenly over the last again probably year to 18 months have become the hot flavor of the day for private equity firms to invest in on the healthcare side. Dental has been just about as steady as as anything from a private equity investment perspective over the last 20 years, it feels like. Some of the areas that we are spending time in and really interested in, I mean, I think a general theme and concept is just continuing to bring care into lower cost settings, and ideally, ultimately, the home. Knowing that is the most preferred site of care for patients, it is the least expensive site of care from a cost and payment perspective. And we're also very big on, again, just kind of a very broad theme of kind of outsourcing non-core services, whether that be to pharma companies, payers, providers, with the idea that the world is not getting easier for kind of those three constituents, payers, providers, pharma, to operate, and with limited resources, they all really need to focus on kind of like highest and best use of talent. And so if we can carve off, some finance and accounting, IR and PR for, biotech firms, like one of our portfolio companies, Danforth Advisors does, that creates an opportunity for, the pharma and biotech companies to really focus on what they do best, while allowing us to build a business that's, really helping them kind of advance their mission. So that's one example, but a general theme that we're looking at pretty seriously across a number of different kind of end markets.
Let's end with sort of pulling out the crystal ball and thinking about kind of what's going to happen, at least in the first quarter. One of the things that I will comment on before I even ask you for your thoughts is that 2023, at least for me, right, started out with an enormous number of people saying this is the year. Like I've got so many things that we're putting to market in the first quarter. So many, things are going to happen, and 90% of that didn't happen, right?
Yeah.
And so, and I don't see, although I can tell you I'm not reading the WSJ every morning, right? But I don't see that particularly some of the macroeconomic things that are happening, right? It's changing dramatically in the next couple of months. And anyway, and so a little bit of layup to, what do you think we can expect in the next year? What do you feel like we're going to see?
Yeah. I'll get there, but I will similarly take the kind of, where we've come from route. So go back to JP Morgan, kind of January 2023. Folks were saying, yeah, we know, kind of things are a little bit slow now. Second half of the year, we're gonna turn the corner. And got to the second half of the year, and it was like, all right, after Labor Day, end of Q3, Q4, it's floodgates are gonna open, and we got there, and it was kind of, well, this year's shot, 23s we're done, but 24, we think it's gonna be so look. Well, part of this, a lesson in part of this is all of us, but particularly bankers, not to to toss stones at them, love to just talk into existence, kind of the bullish markets yet again. But it also just feels like we have kind of continued to see on the horizon, the floodgates will open at some point. When's it going to be? When's it going to be? When's it going to be? What's the catalyst kind of going to be? I don't see what it is. I think I share a little bit of kind of your sentiment, Ari. I'm not sure that things change, in the near term all that dramatically. Will the stability of interest rates, as opposed to kind of consistent increases, give folks a little bit more confidence? I can run my model and kind of have a better baseline of where I think things will be. And therefore, even if, that the higher interest rates have shrunk my returns a little bit, I can kind of underwrite what the interest rate environment is going to look like. That'll help. We've got an election coming up in 24. I don't think that's going to influence a whole lot. Unlike, it maybe has in some prior years. I don't think anyone has really proposed drastic economic or healthcare, change or reform. So I don't think that changes a whole lot. But I think a couple of pieces. So when will this turn, and what will be the catalyst? I don't know. But what I can tell you is there is a increasing and mounting pressure along a couple different realms. One is funds that have been holding on to companies, waiting for the time to sell. At some point, just given fund cycles, it may be time to just take your medicine and exit, even if it's not quite the valuation that you had hoped for, or you thought you were going to get in 2021, or you have on your books. Similarly, there's again a lot of private capital out there. The way private equity funds work is we have a certain number of years to put the money to work and a certain number of years to kind of get it back. And so, if you kind of went pencils down for the last sort of 18 months, going on the better part of 2 years, you're going to get pretty antsy about, gee, we got to get some stuff done and we really got to, be deploying some capital. So, those are pieces that I don't know when the, kind of the pressure and the need to deploy capital and return capital will kind of overwhelm the discipline. But you got to think at some point, it kind of will be happening. So that's been the case for the last 18 months. It may still be the case for 18 more months, but at some point, that's the floodgates will need to open, if only for those, sort of those, just speaking from a healthcare private equity investment perspective, from those perspectives of, gosh, I got to get money to work and I got to get money back to my, to my LPs.
Yeah, it's interesting. I've seen only anecdotally and sort of a couple of examples of, and I wonder if this particular kind of thing is going to pick up pace, which is some of the more lower middle market funds saying to each other, rather than going and finding add-ons or other kinds of particularly new investments, are literally looking at each other's portfolios and saying, you've got this, I've got this. We throw these together, maybe we can throw them up market, and still do pretty decent on them.
Yeah.
Whereas if we individually tried to do something, we probably wouldn't get to where we wanted to be with it, and I found that interesting and I've also talked to bankers who are actively trying to do that, right? They're rather than signing up, they're signing up, a potential sell side and then immediately running around trying to find the combination, right? Rather than to just put the thing to market. And I wonder if we're going to see more of that in the first quarter. That's just sort of who knows, right? I mean, because I do think, look, everything that you've said, I think is obviously very true. As folks have to do things with what they're holding on to, and they've got to do things with their money, right? And another year where deal making is as low as it was this year. It just doesn't. I just can't see it happen again. I don't know how it can happen. But
yeah, it'll just increase that pressure, right? It just increase. It's like a the kettle on the stove. It's just kind of continuing to boil and get hotter and hotter. So. We'll see, but I think the consolidation point you hit. I think the consolidation point you hit is a very good one. I think that's a bit of a release valve if we're going to keep going with the pressure thing, where companies can kind of merge together, hopefully get a better outcome, and then companies that have no more runway, companies that are burning cash and kind of don't have a runway to any kind of exit, but they and their investors say, gee, we can flip into another business, maybe even just for stock and live to fight another day. I think you could certainly see a decent amount more of that, and particularly as this, as the paucity of deal flow kind of continues.
I also think there's some interesting stuff that I think that the effect of the pandemic on professional practice founders, right, has not worn off. And the effect that I'm talking about is even the guy who's in his early 50s saying, got into this business, got a great practice, really was excited about running my own business as well as doing all my clinical care. But gee, the idea that I had to go tell my receptionist that she's got to go home, and I don't know if we'll be able to bring her back and all that kind of stuff. I don't ever want to do that again. Yeah. I'd rather have somebody else deal with that. and and also you've got a generation of new professionals that are for the most part very open to just working 9 to 5 for somebody. Give me a paycheck. I don't need to run my own business. Work 4 days a week, right? Kind of a thing. And perfectly fine with me. And that generation is in effect helping to build out a lot of these PPM structures, right? Because they're willing to come into those practices and some of them, eventually want to find a way into ownership, so to speak, and that's a whole different, just a entirely different webinar for another day. But I do think that you're not going to see the stuff that's happening in professional practice management go away in 2024, right?
Sure.
Although that's still not enough to sustain really bringing up deal flow, right, and deals in general. Well, with that said, why don't we, with our remaining time, why don't we see if we've got any questions? And so if you've got questions, you can throw them in the chat Q&A, and we'll see if Pete and I can respond to them. Don't wasting that one first question to get started, and then it goes on.
I'm surprised you didn't seed the market and give somebody a layup. Tell me more about Venable and your work, Ari.
You threw out there, by the way, and I will plug something right now. You threw out there the acronym soup that we have in this industry. I'm actually almost at the very tail end of getting a book published on health law and policy acronyms and terms from the American Health Law Association. So I'll plug it. It'll be useful to everybody who's playing around in the healthcare industry.
Yeah, going to go on every new associate's desk as part of training. Yeah.
When I started to do it, there were some things that I was just like, that's an acronym. Like, I never even heard of that one. Like, not that I would have heard everything, but it was just sort of
sure.
Anyway, so we do have one quick question, which is sort of thinking about the long-term care market. Actually, Pete, I think you and I actually had a conversation about this a few weeks back. It's been interesting, and this dovetails into our conversation before about enforcement and scrutiny. There's been a lot of chatter out of Congress, out of the White House, generally about private equity investment in long-term care.
Yeah.
And one of the things that I keep scratching my head over is the fact that the operations, particularly in skilled nursing, right, their margins are almost negative. They're so terrible that simply is not a target for good investment, private equity investment, right? Just simply isn't. And the idea that somehow private equity is sort of this big bad actor in that marketplace is always amusing to me, because it just doesn't make any sense. They're not in that marketplace, right? Yes, there are unequivocally REITs. There are specialty actors in that marketplace that may call themselves private equity, but really are not what we think of as private equity. And there also are healthcare real estate focused private equity funds in real estate. And look, we can debate forever how they act on the marketplace, in that specific marketplace, in the skilled nursing marketplace. But in general, the chatter about how private equity is sort of creating horrible outcomes in skilled nursing, I just don't get. It doesn't equate. And I don't know if you've been to add to that, but I scratch my head and say, I don't know what people are talking. I don't know how they're putting this together.
Yeah, for whatever reason, and I won't pontificate on it or hypothesize about the scrutiny in private equity ownership of skilled nursing facilities, in addition to private equity ownership, not in long-term care, but of hospitals generally, has been really, there's been kind of sort of legislative focus on this. Again, maybe it's just where I sit and play. I don't see a ton of that happening and it being a huge impact, but I do think look broadly, the long-term care market, back to one of the concepts I was talking about being, interested in moving care out of the hospital, out of the higher cost sites of care. Well, long-term care is one of the best places to do that, to move folks out of the hospital more quickly, out of the skilled nursing facility, out of an assisted living facility, into the home. That's one of the better ways to kind of bend the cost curve, to use the silly industry parlance, because of how much money is spent on kind of late in life and end of life care. And so I would also go from a different route. I mean, there's been a lot of investment in those places because of the ability to bend care, and we're trying to push care that way. But then you also see, Congress and CMS, cutting rates for home health, providers, while they've seen, wage inflation of 15-20%, and they're getting a, negative, kind of rate, bump from year to year, or it's, ends up, I can't remember what the proposed rate is, but sub 2% for sure on, on an increase. So I think we're talking out of both sides of our mouth a little bit, as a country, around that kind of care.
Yeah, I agree. So a couple of other questions. Why don't we take this one, which is just kind of the, telehealth has taken off dramatically in COVID. It took off dramatically as a result of some waivers and other kinds of things. Some of those waivers became permanent, right? Just 2 cents, and knowing that we've got only a couple minutes left, your 2 cents on telehealth and where it's going, what it's going to do for us or not do for us.
Look, telehealth's here to stay. I think folks have really gotten an understanding and appreciation for telehealth, from the pandemic, if they didn't have it prior. But I think you've already seen utilization, drop substantially since kind of the peak areas of the pandemic. And I think what you're going to see moving forward is just a rationalization, specialty by specialty. So, behavioral health, telehealth is, kind of widely recognized as, being effective when we're just, kind of general therapy, pretty effective, eases access in, remote areas, and allows people to, maybe do it in a little bit more convenient and discreet manner. That's something I think you'll see, just continued enthusiasm for and continued support for. Other areas, less so. Dermatology, probably not going to be as big. Folks were trying to do it during the pandemic, but if I tell you to take a look at this spot, it's a little bit tough to do with over a camera. So I think it's going to be specialty by specialty, but I think I do think while regulation will struggle to keep up a little bit, it'll get there and kind of ultimately support continued use of telemedicine.
Yeah, no, I absolutely. I mean, I've seen it where, and this is essentially just summing up what you just said. Whereas I can always tell people, you can't do orthopedic surgery via telehealth, right? You can do mid-management behavioral health, right? And that will work forever. It'll always be a good way to do that if you need to, right?
Yeah.
And I think that's where we are, and where we'll pretty much always be. I mean, interestingly, dermatology, you throw AI into that, and things may change, right?
Totally.
If the doc can say, take a picture with your phone with this app of that thing on your hand, right? And they have some technology to figure out what that may or may not be, and takes a really, really high-res image, right, that the doc can see, that may change things. You just don't know. That may be where technology and telehealth start to do something and work in the future, right?
Yeah, absolutely.
Well, we're at the end of the hour. Pete, I can't thank you enough. This has been a really, really fun and wonderful conversation. Uh, um, Thank you, everybody, for joining us today. A quick plug again for January 24th. I'll be talking to Vasanta Pundarika from Matrix Capital Markets Group a bit about what she thinks is happening in the market and also some predictions for 2024. And again, Pete, thank you. Thank you for everybody for joining us, and have a great rest of your day.
Enjoyed it. Thanks, Ari. Have a good one.
Okay.